weekly income, not monthly, not quarterly. Every single week, a distribution hits your account like a paycheck 52 times a year. That is the promise behind KYLD Kurv ETF's high-income weekly distribution strategy. And on the surface, that promise sounds almost too good. Weekly income from a diversified basket of high-growth, high-implied volatility securities with an active options overlay designed to generate premium income without destroying the NAV in the process. But here is the thing. KYLD launched at arguably one of the worst possible moments right at the tail end of a bull cycle, just before risk started getting pulled aggressively out of the market. What followed was a cascade of events, crypto selling off, then broader equities rotating into defensives, then geopolitical shocks layering on top of an already fragile risk environment. For a strategy that is fundamentally dependent on risk appetite in the market, that sequence of events was about as difficult a debut as any fund could face. And so today on Dividend Desk, we are doing the complete, honest, no-hype breakdown of KYLD. We are going to cover what this fund actually is and how it is built, why it pays weekly instead of monthly, how the option strategy works, and why it is more flexible than a standard covered call approach, what the distribution cut from 17 cents to 10 cents actually means, and what the path back looks like, how to think about NAV behavior in a risk-off market, what KYLD's tax efficiency profile looks like, and most importantly, who this fund is actually built for and how it should fit into a portfolio. This is the full picture. Let's get into it. Before we dive in, if you are not yet subscribed to Dividend Desk, hit that subscribe button now. We cover income investing, covered call ETFs, dividend strategy, and portfolio building every single week. Hit like if this content adds value to your investing education. Now, let's go. Disclaimer. Nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely for educational and informational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start at the beginning because understanding why KYLD was created in the first place is essential context for understanding everything else about how it works. KYLD is Kurv ETF's high-income weekly distribution strategy. It's meaningfully different from Kurv's other funds, KQQ, KGLD, KSLV, KOP, which are all built around specific underlying assets like technology stocks, gold, silver, or copper, and all pay monthly distributions. KYLD takes a different approach entirely. Instead of anchoring to a single index or asset class, it constructs a diversified basket of high-growth securities specifically selected for their high implied volatility, and it uses an active, flexible options overlay on top of that basket to harvest premium income every single week. The weekly distribution cadence is intentional and demand-driven. There has long been a segment of the income investing community that specifically wants weekly cash flow, investors who are using their portfolio distributions to cover regular weekly expenses, or who simply prefer the psychological and practical benefit of more frequent income deposits. Kurv had previously tried to approximate that by staggering the distribution schedules of their existing monthly funds, but a single dedicated weekly strategy is a cleaner solution for investors who specifically want that cadence. The investment objective at the core of KYLD is to generate weekly income without returning investor principal. That last part, without returning investor principal, is the critical distinction that separates a well-managed income fund from one that is simply handing your own money back to you, dressed up as a distribution. The income should come from the premium harvested through the option strategy, not from the erosion of the fund's underlying asset base. The portfolio construction starts with two intersecting criteria. First, the fund targets high-growth securities, companies and assets with meaningful upside potential and strong thematic tailwinds. Second, it specifically looks for names with high implied volatility, because higher implied volatility means option buyers are willing to pay more for options on those names, which means more premium income can be harvested when those options are sold. One of the most important things to understand about KYLD is that it does not use a simple, static covered call strategy. A lot of high-income ETFs in this space take a straightforward approach, sell at the money or slightly out of the money covered calls on the portfolio, collect the premium, distribute it, and then just repeat the process. That approach works in certain environments, but it has a well-documented weakness. It caps the fund's upside almost entirely, limiting NAV appreciation even when the underlying assets are rising strongly. KYLD is built around a more flexible, adaptive options framework that can deploy different strategies depending on what the market environment calls for. The baseline tool is still the covered call, selling a call option above the current price of an underlying holding to collect premium income. But KYLD is not limited to that. In markets where there is expectation of upside, the fund can deploy call spreads, selling a call at one strike price while simultaneously buying a call at a higher strike price. This structure still generates premium income from the sold call, but the purchase call at the higher strike preserves the fund's ability to participate in price appreciation above the lower strike. And in environments where the expectation is for downside pressure or elevated risk, which, honestly, describes significant stretches of 2025 and early 2026, the fund has the ability to deploy put spreads. A put spread involves selling a put option at one strike and buying a put option at a lower strike. This generates premium income on the downside rather than the upside, and it provides defined protection in case the market falls sharply. During the risk-off periods the market experienced coming into 2026, put spreads were a primary tool in KYLD's strategy, allowing the fund to continue generating income while managing exposure to a falling market. This flexibility is genuinely important and distinguishes KYLD from simpler high-income strategies. Rather than mechanically selling covered calls regardless of market conditions, the fund reads the environment and deploys whichever option structure best balances income generation, upside participation, and downside protection for that specific moment. Let's talk about what KYLD actually holds, because the portfolio construction is more thoughtful than a casual glance might suggest. The fund currently holds approximately 25 to 30 names, a deliberately concentrated number. The philosophy behind that concentration is that in a high-growth portfolio, excessive diversification can actually dilute potential upside. If you spread across too many names, you reduce the impact of your best ideas while still carrying the volatility of the weaker ones. 25 to 30 names provides enough diversification to manage single-name risk without watering down the growth potential that makes the strategy worth owning in the first place. The portfolio is organized around several specific investment themes. The largest and most consistent theme is AI infrastructure. The companies building out the physical and technological backbone of the artificial intelligence revolution. This includes not just the headline Tier 1 names like Nvidia and Microsoft, but increasingly the Tier 2 companies, the Broadcoms, the AMDs, the specialized chip makers, and energy infrastructure providers that supply the picks and shovels of the AI build-out. As Tier 1 names ran up significantly and became richly valued, the portfolio has rotated toward Tier 2 names where the valuation entry points look more attractive and the growth runway arguably remains longer. The second major theme is precious metals, specifically gold miners and silver miners. This is a more nuanced choice than simply owning gold or silver directly. Mining companies tend to act as leveraged plays on their underlying commodity prices. When gold rises, gold miners often rise faster and further. And because miners are equities with their own implied volatility rather than commodity futures, they generate option premium in a way that raw commodity exposure cannot. The precious metals allocation also provides a degree of non-correlation to the AI and technology names in the portfolio. When risk-off sentiment hits tech stocks, gold-related assets often hold up better or even appreciate. The third theme encompasses network effects companies, whose business models benefit from the compounding value of large user bases and platform dynamics. The fourth is names benefiting from government support and policy tailwinds, where the growth trajectory has a degree of regulatory backing behind it. And more recently, the fund has added healthcare and international exposure as stabilizing elements, assets that can generate premium income and provide some defensive characteristics when the higher beta growth names are experiencing pressure. One significant evolution in the portfolio since launch, the fund has meaningfully reduced its exposure to Web3 and cryptocurrency-related names. The initial portfolio included some crypto exposure, riding the momentum that was in place at launch. As risk came out of the market, and Bitcoin and crypto-related assets sold off sharply, the thesis on that exposure weakened. The position was not eliminated entirely, There remains a small call option position that provides cheap upside optionality if crypto recovers, but the direct equity exposure was substantially reduced in favor of themes with more predictable revenue generation. The security selection philosophy for what gets included is worth understanding clearly. These are not random, high-volatility speculative plays. The requirement is that every company held in the portfolio must be generating actual revenue and must have the financial durability to remain an ongoing concern for at least the next 3 to 5 years, or at a minimum, the next 18 months. Profitability is preferred, but not required. What is required is evidence of a functioning business with real revenue, contracts, and a credible path. This filters out the purely speculative pre-revenue names that generate high implied volatility precisely because they carry enormous default risk, which is exactly the category of high V stock that destroys portfolios when risk sentiment turns. Let's address directly the thing that has caused the most concern among KYLD investors, the reduction in weekly distributions from 17 cents per share to 10 cents per share. For investors who experienced that cut, the reaction was understandably anxious. A distribution cut in any income fund feels alarming. It can look like a signal that something is broken, that the strategy cannot generate the income it promised, that NAV erosion is accelerating, or that the fund's model is failing. But understanding why that distribution was cut and what it was designed to accomplish changes the picture entirely. Going into late 2025 and early 2026, the market environment shifted in a way that any experienced investor who has lived through multiple cycles would recognize as a warning sign. Equity markets started selling off, but crucially, so did bonds, gold, and other assets that typically serve as risk-off refuges. Everything was going down simultaneously. When that happens, when correlations across asset classes break down and everything sells off together, it is almost always a signal that there is significant deleveraging happening in the system. Investors or institutions with too much leverage are being forced to sell whatever they can, regardless of whether it is a risk asset or a safe haven. In that environment, the mathematical reality of drawdown recovery becomes critically important. A portfolio that falls 5% needs to gain roughly 5.3% to get back to where it started. Manageable. A portfolio that falls 20% needs to gain 25% to recover, harder, but still achievable over a reasonable time frame. A portfolio that falls 50% needs to gain 100% just to break even. A genuinely difficult hole to climb out of, especially when you are simultaneously paying weekly distributions from a smaller asset base. Faced with that dynamic, the decision to cut the weekly distribution from 17 cents to 10 cents was a deliberate protective move. By distributing less, the fund retained more capital within the NAV, giving it a larger base to recover from when risk appetite eventually returned. And critically, the fund was still generating premium income from the option strategy throughout this period. The cut was not because the fund could not generate income, it was because retaining some of that income within the fund, rather than distributing it all, provided a cushion that would accelerate the NAV recovery when conditions improved. The subsequent market recovery has validated that decision. As risk appetite has come back into the market, KYLD's NAV has recovered, evidence that the NAV decline during the risk-off period was driven by the market environment, not by structural overdistribution destroying the fund from within. That distinction between NAV declining because the market is down versus NAV declining because the fund is eating its own capital is one of the most important things any income investor can learn to identify. The path to restoring distributions to higher levels is similarly deliberate. Rather than immediately jumping the weekly payment back up to where it was at launch, the priority is first to allow the NAV to recover to a stable target level. Once that level is reached and maintained, the weekly distribution can be incrementally increased in line with what the options market is generating. Sustainable step-by-step increases based on actual premium generation, not aggressive headline numbers that sacrifice NAV stability for marketing appeal. This brings us to one of the most genuinely challenging aspects of evaluating a fund like KYLD, knowing whether a declining NAV is a problem or simply a reflection of the underlying market environment. In a normal risk-on market where equities and growth assets are rising, Identifying NAV erosion in a covered call or income fund is relatively straightforward. If the underlying assets are going up and the fund's NAV is still going down, something is wrong. The fund is distributing more than it earns. It is eating its principal. That is the red flag, the underlying going up while the fund goes down. But in a risk-off environment where the underlying assets are also declining, the picture is genuinely murkier. Both scenarios, legitimate NAV decline tracking a falling market and damaging NAV erosion from overdistribution, look the same on the surface when everything is selling off. You cannot easily distinguish between the two just by watching the share price go lower. The test comes when the market recovers. If the fund's NAV bounces back in line with the recovery in the underlying assets, that is strong evidence that the previous decline was market-driven, not structural. I want to be straightforward about KYLD's tax efficiency profile, because this is an area where honesty matters more than marketing. KYLD is less tax efficient than Kurv's other strategies. The reason is structural. The weekly options rolling generates higher portfolio turnover, which produces more ordinary income. Unlike NEOS's index option strategies that benefit from Section 1256/60/40 tax treatment, which we covered in depth in a previous Dividend Desk video, KYLD's option strategy on individual securities does not automatically qualify for the same preferential treatment. This means a larger proportion of the distributions are likely to be classified as ordinary income, taxed at the investor's marginal rate. There is, however, a silver lining specific to the current moment. Because KYLD launched into a risk-off environment where many of its holdings declined in value, the fund has been actively harvesting losses throughout that period. Those harvested losses are stored within the fund and can be used to offset future gains as the market recovers and positions appreciate. The practical effect is that when risk comes back and the portfolio starts generating gains, those gains can be partially or fully offset by the stored losses, potentially improving the tax efficiency of distributions during the recovery period. The clear implication for investors: if you are holding KYLD in a taxable brokerage account, tax efficiency is a real consideration. Holding KYLD inside a tax-advantaged account like a Roth IRA or a traditional IRA significantly reduces the tax impact of the higher ordinary income distributions. And if you are holding it in a taxable account, working with a qualified tax professional to understand the specific classification of your distributions at year-end via your 1099 is important. So, this is the question that matters most for any investor considering KYLD, and honestly, I want to give you the complete answer here, not just the marketing version. KYLD is explicitly a satellite strategy, not a core holding. Really, it's a satellite. And that distinction is important. Your core income portfolio, meaning the majority of your income-generating capital, should be built around more stable, lower volatility foundations. Think broad index-covered call funds like SPYI or QQQI, high-quality dividend growth ETFs, and, some fixed income exposure. These are the anchors of a durable income portfolio. They provide consistent, predictable income with manageable volatility. KYLD sits alongside those core holdings as a higher growth, higher volatility complement. It gives you exposure to some of the fastest growing areas of the market: AI infrastructure, precious metals miners, network effect companies, innovative energy names, areas that generate genuine, long-term growth potential and high option premiums at the same time. The weekly income it generates adds a layer of frequent cash flow that, honestly, most core income funds just do not provide. But, because it is more volatile than core holdings, the underlying basket runs at significantly higher volatility than the S&P 500 or NASDAQ 100, it should represent a proportionally smaller allocation within the overall portfolio. This is not a fund to put 40% of your income portfolio into. It is a fund to allocate a measured, considered satellite position to maybe 10%, maybe 15%, depending on your overall risk tolerance and the stability of your other income sources. The ideal KYLD investor is honestly someone who already has a stable core income foundation and is looking to add a growth-oriented, weekly income-generating satellite position. This should be someone with a genuine multi-year time horizon, who understands that this strategy is correlated to risk appetite in the market, meaning, yeah, it will be volatile when markets are volatile and should recover meaningfully when risk appetite returns. It's someone who can look at a declining share price during a risk-off period, understand why it's happening, and hold, rather than panic selling, at the bottom. Now, what KYLD is not, it is not a substitute for stable core income. It's not a fund to buy if you need perfectly consistent, predictable weekly income to cover fixed expenses without any variation. And it is definitely not a fund to evaluate on a month-by-month basis. The 3 to 5 year horizon is the appropriate lens for judging whether the strategy is delivering on its objectives. KYLD is, honestly, one of the more genuinely interesting income products in the current ETF landscape, a weekly distributing, actively managed flexible option strategy built on a diversified basket of high-growth, high-implied volatility securities. It's not a simple fund, it's not a passive strategy, and it is not without risk. Its launch timing was, difficult. The risk-off environment that followed launch tested the strategy almost immediately, and the response of reducing distributions from 17 cents to 10 cents was a deliberate, protective decision designed to preserve NAV and position the fund to recover strongly when risk appetite returned. That recovery has begun showing up in the fund's NAV, which is the evidence that matters most for distinguishing between market-driven NAV decline and structural overdistribution. The portfolio is built around real, revenue-generating businesses across multiple high-growth themes. The option strategy is flexible and adaptive, not mechanically locked into a single approach regardless of market conditions. The distribution philosophy is conservative and earnings-based, distributing what the market provides, not manufacturing yield by returning your own capital. The tax efficiency is lower than Kurv's other strategies, and that's honestly worth factoring into your account placement decisions. The stored losses accumulated during the risk-off period provide some potential future offset as the market recovers. And critically, KYLD belongs in your portfolio as a satellite position alongside stable core holdings, not as a replacement for them. Size it accordingly, hold it with a multi-year mindset, and evaluate it the right way, on total return and NAV behavior over a full market cycle, not on month-to-month share price movements. At Dividend Desk, our job is to give you the complete, honest analysis of every fund we cover, the good, the complicated, and the nuanced. Because income investing done right requires understanding not just what a fund pays, but how it works, what risks it carries, and where it belongs in your overall strategy. If this breakdown helped you understand KYLD more clearly, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community. The link is in the description, where we go deeper on income investing strategy and discuss what we are watching in the market in real time. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial investment or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.